Q&A with Mistress Market Wizard herself, Linda Raschke. Thank you so much for coming in.
Ooh, mistress. Ooh.
I knew you'd like that.
Out of a madam or a ms or a mistress. Okay.
Yeah, hey, not that there's anything wrong with that. I go all the way. Anyways, Linda Raschke, as I tweeted out, and I mean this in the best possible way, has been trading longer than most of you have been alive. So we're going to, not that you can tell at all, not that you can tell at all, but my point is, she
Because I
has
use old photos.
she has more experience and has seen literally the evolution of markets from the most primitive to the most sophisticated. And most important, this is the incredibly interesting thing about her, is not only has she seen the evolution, but she's been the primary actor in every one of the changes of the trading revolution, including the current one, which is all algo computer driven. And we get a chance here to really explore a little bit of her history, her trading style, and then I'm going to ask. I have a whole bunch of questions from people who want to ask you stuff. But if you don't mind, since I get to run the show, I get to ask the questions first. I have a whole bunch of stuff that I wanted to talk to you about. And first and foremost, for those of you who are not familiar, maybe you could just give us a 30-second rundown of how you started and your basic history of getting involved in the markets.
I started on the floor of the stock exchange out in San Francisco, the Pacifico Stock Exchange. I was a market maker in the equity options. So that was my first background, was primarily doing a lot of arbitrage. And then I was on the floor of the Philadelphia Stock Exchange as a member there, doing the same thing, a lot of equity option arbitrage. And I started trading futures actually out in at the Pacifico Stock Exchange. I traded the S&P futures the very first day they were listed, and I've pretty much been trading them ever since. So that's sort of been my bread and butter. After the crash of '87, the options, the liquidity just totally dried up, and I started trading more and more futures. And then in '92, I became a CTA and started managing money with a futures-based program. And I was a hired gun for a couple hedge funds, and they didn't call them hedge funds back in those days. They call, so the terminology and the semantics of this industry has changed greatly. Just keep that in mind. But they were like managed accounts and then commodity funds, commodity pools. And then I eventually started my own hedge fund. Actually, I started several of them, and then I basically retired in, I don't know, was it like 2014, 2015 or something. I just stepped down as being a CTA and a CPO. I was also a commodity pool operator. So, and during that time, I mean, just in terms of the whole evolution of things, I built up a business around me, a team. We had about $150 million, which is probably peanuts, in the big scheme of what you hear of hedge fund money for global macro and stuff like that. We just found big limitations as to what we could move on a shorter duration in the futures markets. So we kind of capped out at that level, which was fine. But in that process too, I had like a full-time programmer, full-time technology guys, and a lot of people probably don't know these things about me. I mean, I had even gone so far as to have bought my own server farm. We had about 140 servers. Each of these are the types of servers that could cost $80,000 a piece. So we really did make a huge foray into, the algorithmic systematic exploration thing. And part of that was because my current husband, who was also my original S&P broker, Damon Pavlados, had been partners with Steve Schuler. And there were three people, Dan and Steve Schuler and my husband, who had a brokerage firm on the floor. And they were the first to see the signs that the business was going to go electronic. And so developed an execution platform left upstairs. Then Steve and Dan went on to form GetGo, which was the founding firm of this high frequency trading market maker algorithmic type of operation. So, I really saw all the inside and knew a lot of these inside players and could see what they were doing. So you had the Citadel, the Peak Six, just the whole group of these guys that were doing the electronic market maker algorithmic functions. And of course, this category of algorithmic execution, trading, whatever, I think is grossly misunderstood, but there's several components of it. So anyway, those are perhaps some questions that I can help address to you today. I did retire. I had these idealistic notions of just, going out and training my horses every day. I own 2 farms, one in Wellington and one up in Illinois, and several dressage horses and so forth. And I got bored to death after like 3 months. I felt like I was missing something every day. So here I am back in front of the screens. I took time out just to also write a book about my trading program, my trading philosophy, some of the horror stories that happened to me in the business, because people don't recognize all the obstacles and challenges and potholes, as well as, your risk exposure to being on the outside of unforeseen events, even if you're just a day trader, so I talk about being in a flash crash and all these kinds of things, but also to pass on so much of the wisdom that I had accumulated over the years from senior people that have now passed, and people that I greatly respect in the industry. So I took a little time to write that, which was also difficult because you're sitting in front of the screens every day. And so that book came out, Trading Sardines, and I'm not sure I'll write another book again just because it's so much work. But here I am still sitting in front of the screens every day, because it's what I know. And just like anything in life, if you play cards or golf or piano or whatever it might be, your passion or your hobby, you have to look at the markets as being really a passion and a hobby first. Forget about the fact that you can lose money or make money, but you have to be in this business because you totally enjoy, playing the game and trading, even though, it still has frustrating moments and so forth. Anyway, I expanded well beyond 30 seconds.
Thank you. I totally agree with you. I always end a lot of my presentations by saying this is the only business where we look forward to Mondays. And in FX, for us, we look forward to Sunday nights. I mean, there are very few people I know in businesses that say, I can't wait until the weekend is over so I can go back to work. And that is just such a powerful aspect of trading that people in some ways underestimate about how fascinating and interesting this enterprise is relative to a lot of other things in the world. So I totally agree with you about, you can't really retire. This is just too much fun to do.
Well, listen, it's fun about 20% of the time. It's yes. A lot of tedious, a lot of patience, a lot of frustration and stuff too. And I'll tell you honestly, there's a lot of Mondays where I don't want to go back to work, but then of course you get caught up in it all again. So. Yeah,
no, I hear you. It definitely goes both ways. I want to go back just to the original, like early days quickly, because you said something interesting, and I'd love to have you, because I think many people don't quite understand how this worked. And this could give a very, very good insight into how markets have changed. You said you used to do equity options arbitrage. Could you give an idea of how that worked in practice? What, like one single trade that was an arbitrage trade, how did that work in the olden days?
Well, first of all, I was on the trading floor, and in those days that things were a lot more inefficient, so there's no arbitrage opportunity nowadays. You can sit there and do butterflies and condors and all this kind of nonsense and stuff, and there's zero edge because everything's priced exactly efficiently where it should be on a theoretical basis. So right. On the trading floor, what we were doing, we were market makers. All right. So I should paraphrase that and say I was a market maker first, but the way that you do the market making in the equity options is that the order flow was very one way. So if you can imagine being in a pit where you're trading S&Ps or you're a bank trader, doing Forex or, these types of markets, you pretty much get a two-sided market, paper flow back and forth. So the people in the pits would, okay, you buy the S&P and then you sell it out a tick. There's always constant bid and ask. And what happens with the equity options is that there would be one-way order flow. Like the customers, the clients, the retail, the institutions might only want to be selling a particular option series because they're doing covered rights for their stock. They could be long stocks, so they just want to come and keep selling options, selling options, selling options into the pit. And as a market maker, you have to take them down. That's your job, to make a market and buy them. Or conversely, if there's a takeover speculative particular stock, everybody wants to come and buy the options. Nobody wants to sell them to you. So your job in that case is to sell the options. So it ends up being a very one-sided order flow, and therefore you have to find creative ways to hedge that, because you can't just end up with unlimited directional risk. So you have to learn to either trade against a stock, buy stock, sell options, or buy the options and sell the stock and then trade the stock around it to adjust your position. It's dancing quite a bit. Very early on, I would say like in 1981, 82, there was enough of an edge where the options were out of line that you could buy, a different series in a different month and put on, for example, a calendar spread. You'd have to find where the order flow was going the other way in some other option. And then, of course, by the time expiration comes, the theoreticals, gravitate towards what they should be, and hopefully you made money. But yeah, it was just a different world back then, and it was a much more strategic world, and it wasn't easy because you had to work around these skews in having lack of liquidity in one series, and everybody wants to do the same thing in the other series, and it forced you to be a really good stock trader to adjust your position.
Now, what's interesting about that is these are classic sort of market making skills that you obviously learned early. They're all essentially mean reversion skills, and they are universal to every market that trades, and certainly universal to FX, which is a very dealer-driven market. And actually, what's happened now in the modern world is that these high-frequency algos, the Virtus of this world, the Citadels of this world, are actually the robotic versions of these market makers. They're always this is one of the reasons why volatility has been such a tough thing to trade, because they're always selling the offers, buying the bids, trying to dampen the moves and be on the opposite side. But I'm wondering, has those core skills that you had you learned on the exchange, and then you moved over to Philly, and I'm sure you probably practiced those skills there, has that whole behavior completely changed now that you're when you move to become an upstairs trader, or do you still rely on a lot of those innate mean reversion market making skills in structuring models?
No, it completely changed in the 80s. I would say that it was all irrelevant and passe as of 1990. It was completely passe. So it doesn't matter. It just, what it did is it bought you time to continue to study markets, study technical analysis, try trading different markets, different products and stuff like that. It basically bought you time, about 10 years of education time. But in terms of the skills, I would have to say that the skill set for being a trader doesn't really have anything to do with the mechanics of the execution as much as you might think. The skill set in being a trader really has to do with your own steadiness and temperament and emotional control and planning and understanding the dynamics of speculation, in terms of when is a time to buy and when is a time to go against the crowd. Not that you're necessarily going against the crowd, but also understanding the type of of strategies that you're good at. You know, are you good in a momentum environment? Are you good at breakout strategies? Are you good at, you know, there's a lot of different variables like that. So,
How would
yeah.
how would a person find out what they're good at? How did you find out what you were good at? Like,
Well, the only way that you find out in probably 99% of different things in life is by trying. And that's why people so far underestimate the learning curve, is that you have to try it and see if it works for you, and then try it and see if it works for you. And this whole process can take 3 or 4 years. Let me try spread trading. Let me try seasonals. Let me try day trading. Let me try trend following. Let me try, you know, you have to go through this process, however, whatever buckets you want to put it in, you know, let me try systems development, you know, and this whole thing really takes at least 3 or 4 or 5 years at a minimum. And so whatever you start doing initially is like getting your toes wet, and it's going to get you into the process, but probably what you're going to end up doing for making a living is not going to be what you end up doing initially when you're starting out trading. You really have to find a niche, and you know, different styles work with different people's personalities and temperaments.
yes, but it also sounds like it's not just knowing your own personality and temperament that matters. It's finding the kind of trading, like you said, there's a million different trade strategies that can apply to a variety of personalities and temperaments. And it's actually discovering the kind of trade strategy that is in alignment with your own personality, that it results essentially in a steady and confident performance going forward, right? It's not just you know, the common thing I always hear is, first you have to really know yourself, and then once you know yourself, you can then apply a strategy. And I think that's too simplistic of you. Yes, you have to know yourself, but then you also have to go, like you said, and do all this work and try a whole bunch of different assets and strategies and everything else before you settle down on something that you are comfortable with. Would you say that's true?
Yeah, but you can't just be doing a smorgasbord of stuff. You know, when you do test something out or try something, you have to really spend 3 months doing that just to see how the numbers play out, just to give it a fair shot. And you can't do more than two things at once. So, for example, you might want to start off looking at, like, say, a volatility breakout system, because that is about the only mechanical system that I would ever consider. And I don't trade mechanical systems for a very strong reason. You know, but that, if I did, that would be the only one that I perceive as have a decent edge for a retail type of client. You know, trend following systems do not have an edge for an individual, because the drawdown history can be way too long and way too steep. And the reason that trend followers survive is because they're making a management fee to run a very specific type of asset program, you know, for that complements a bigger portfolio for clients. Okay, so no individual retail. I've never met an individual trader that makes a living doing trend following in 40 years of seeing hundreds of thousands of traders, you know, but it
Wow.
will have an edge. Okay, it's just not going to work for an individual. And so,
And yet the
so
irony is that trend following is the single most common technique taught to retail traders over and over and over again. Yeah.
Well, but, you know, who's teaching these techniques? Obviously, people that aren't trading them and making a living off of them themselves. They're making their money teaching. Okay, so let's have a real good distinction there. Show me somebody that shows their real account year after year with their own trend following performance. Okay, and you know, so people need to be a little bit cynical and open their eyes here. You know, it's a very easy thing to teach because Russell Stans popularized it, you know, from that original Turtles program, and then Michael Covell wrote all these books and so forth. These guys are not trading for a living. Okay, so just be really clear on that. The
Absolutely.
point about trend following is that yes, there is merit in trading in the direction of the supply demand imbalance. Absolutely. That's where there's an edge. But what is not taught with the trend following is the need to do a portfolio of a minimum of 14 markets at once, because typically what will happen is 2 or 3 of those markets are going to make your stats for the year, and you can get chopped up in the rest of them. So you're really playing for an outlier or a trend that is caused by change in central bank policy, these types of things. And then the other thing that is not taught at all about the trend following is the characteristics of the equity curve, the extent of the drawdown, as well as the duration of the drawdown. And every trend following CTA or fund that has been in business for 20, 30, 40 years, they have all had 40% drawdowns. And they have all had peak to valley stats that are like at least 10 months. Meaning, if you lose money, it takes at least 10 months to get back up to that high water mark that you were at. So these things are not taught to the retail. And so it does a great disservice in thinking that this is a viable strategy for them, when the truth is it's not, So that's my 2 cents worth.
Interesting. So you brought up a point, which is kind of your trademark in some ways, the ability to come back. I mean, anybody who's read your story knows very well, and in the new book, Trading Sardines, you talk about that as well, how many times, at least certainly more than once in your career, you've just had a tidal wave hit you for whatever reasons. The first time when you got blown out selling strangles, or it was a straddle or strangles, I'm not sure. Straddles on the Pacific Exchange, a time when it just happened, the Fed decided to change rate policy on the close of the market, and you had sold a massive position in the S&P, all those things. And, I wrote a column, I read a column like once a week for a lot of my retailers, and I wrote a column about Martin Brodeur, who is considered to be like one of the greatest goalkeepers in the history of NHL, for one simple reason. He is able to completely shrug off a horrible game and come back the next game and just be a rock, be a wall. And if nothing characterizes sort of your success in history throughout trading, is just your ability to come back from adversity, whether it's self-forced or market-forced or just, the fate of the gods. And so maybe, I know it's impossible because obviously, they're very unique to you, but maybe you could just share just a couple of mental tricks or mental skills that you've acquired in your ability to come back from losers, because I think that's the single hardest and also the single greatest reason why most people quit. It's not because they're doing badly, it's not because they're bad traders, it's because they just have one bad experience and they don't have the mental faculties to come back from that. Maybe you could talk to that a little bit.
Well, the mental faculties come from a confidence level in your own methodology and style. Okay, so that's really, really important. And it was interesting because, I know that you met Mandy when she was out here in my office for a month. She traded with me for a month in July because she went to that Chicago Expo. Mandy Porfrofson Johnny is actually a coach of sorts. She wouldn't, I don't know if she'd call herself a coach or what she calls herself, but she also trades. She trades, every week and does pretty decently. So she made a big point about talking how when people get more emotional or reactive or these things that are disruptive to our trading, okay, one of the ways that you can recenter yourself and get back into the mindset that you need to be in for a trader is through statistics and strategies and numbers and record keeping and these types of things that completely push out these disruptive, emotional, either reactive or despair or tilt type of tendencies. So be aware of the type of person that you are in the very first place. Richard Dennis, and his sidekick there, when they were first selecting the turtles for their program on the trend following, made a very concerted effort to select people with a background in game theory or poker or mathematics. Liz Cheval was the only female trader who was selected to be in the Turtles program. Sadly, she passed at age 55 of an aneurysm, but she was a mathematician and she had gone down to the floor as a clerk, in a different type of capacity, before she applied for the program. As for myself, I am very good at math and music and notes, and I'm terrible at words and writing books. I would have been the worst author or journalist, even though I spent like a lot of time. I feel like my Trading Sardines book came out pretty funny, but that was really hard work for me. And for somebody else, it might come a lot more naturally. So in the book, in chapters of the book, I'll talk about how, my family growing up, we all played cards, we all, were very much, both my brothers have their degrees in applied mathematics and, engineering type stuff, programming type stuff. And it doesn't mean that if you don't have a propensity in these areas, you can't be successful, because Mandy proved that. She's quite one that is on the opposite end of this personality profile spectrum, but she says that she made a concerted effort to do the things that she needed to do, to start doing record keeping, to start doing statistics and things like that, to keep her in a consistent groove. So for me, I always, I logged numbers at the end of every day for 40 years, or 39 years now. I still write down at the end of every day the closing price, the 2-period rate of change, make notes if there's patterns. I do a lot of modeling and testing by hand. For me, if I ever had a bad drawdown or a bad trade or did something stupid, which we all do stuff stupid, I would immediately throw myself into research. Let me develop a new law. Let me develop a new way of looking at something. Okay, well, I was on the wrong side of this. How do I be on the right side of this in the future? So it's tricky when we're traders that, you don't ever see anything productive for your work. You can sit there 8 hours in front of the screen and lose money. And then what does that do for your productivity level? You never have anything to show for it, right? Right? So, at least if you then go, okay, well, let me do back testing on this idea. Let me see what happens if we break out of the first 15-minute range. Let me model this. Let me see if I can create, a new little color rule or something that pops up, that alerts me in the future. So that's one good way that I dealt with, getting myself back from an adverse period. And you just have to look at it one day at a time. You don't say, oh my God, I just lost $4 million. How am I going to make that back? No, you just go back in the next day and say, let me do my best job this day. And then the next day, let me do my best job this day, and so forth. And that's how you have to do it.
Interesting. You know what? Listening to you is just fascinating, because I kind of do a lot of stuff which you do. I never realized it, but like when things go badly with me, I do the exact same thing, which is I go back to the drawing board and I say, okay, this strategy is not working. What can work? And very often, like, it's amazing how sometimes you can look at in your worst drawdown periods, you actually sometimes get amazing creative ideas, and you can look at stuff with fresh eyes and suddenly make tweaks and changes to systems that then create much better results as you go forward. But that whole mentality of like, let's go back to the drawing board and do research. I kind of did this naturally, and it's so fascinating to hear you say it, because it gives me a lot of hope that maybe I'm on the right side of attitude doing that. So there's so many questions that I have.
Well, let's go, rock and roll. Hey, I've had my coffee.
Thank you. And I hope you guys can stay with us, because guys, I'm going to go, because how often do we get to talk to Belinda Raschke? I'm going to go, and I really want to delve into some specifics. I know you generally like to talk about models and strategy and your whole point is that tactics are the least important part, but I still want to ask you about tactics because it's fascinating to me. I'm just curious about your own personal tactics. So I'm going to ask you a whole bunch of questions. And feel free to ignore them or ask them, but I'm going to ask them in one single swoop. Do you enter single entry or scale in? Do you exit single exit or scale out? Do you trail your stops? And how basically do you position size any given trade in terms of percent of equity? So those are like sort of my basic, mechanical questions. How do you approach all those things?
I'm all in, okay? I don't like scaling in because you're going to end up scaling into the losers and you're never going to have enough in on the winners. Also, when you first initiate, that's when your risk is best defined, right? So I'm a strong proponent of do not scale in, all right? It's the worst habit in the whole frickin' world because you'll fall back onto scaling in, to average a cost. It's just a lousy practice. So I'm all in. Once I'm, huh?
Yeah, I was gonna say, what about on the other end of it, on taking profits?
Yeah. Once you're in it, how you take profits and how you exit a strategy totally depends on the individual strategy and trade. Most of my stuff, it doesn't. You will, if you're trying to be a more systematic trader, it does you wrong to scale out. Okay, you want to be all in, all out, and I'll tell you where that is. There's variations in that. Okay, so let's say, for example, a volatility breakout system, just because that's a black and white model that is what it is, and I've got just numbers on a zillion variations of that going back so many years. So you're all in with that model, okay? Boom, it triggers, you're all in. And now, let's say your objective is to exit on the next day's opening, okay? Or exit on a test above the previous day's high. Something along the lines of, I'm sure everybody's familiar with Toby Crabell's work at some point because he did so much work on this, or Larry Williams for that matter. I mean, there's a lot of people that have publicly put out a lot of work there. And what'll happen is if you just take a piece off, okay, the whole point of these strategies is that they put you in the best position of capturing a fat tail. And that's the best thing about these markets that people should make a concerted effort to capture is you're always putting yourself in the position for capturing a fat tail. We just don't know where that's going to come from or how or when. It's called a big winner. And that's really what is going to make your bottom line at the end of the year. So is capturing a few of these big glorious days and so forth. And so if you get into the habit of taking partial profits along the way, you'll find that it's very easy to take partial profits on the stuff that is working, and that's exactly where you don't want to take partial profits. Again, I'm talking about in a purist sense in terms of pure numbers. In terms of pure numbers, you don't really want to scale out. You want to be all in, all out. Now, there's the difference on that is there are certain patterns where it pays to trail a stop, okay? And you need to be very clear about what type of structure you can trail a stop on. So, for example, everybody's familiar with the concept of a continuation pattern, which could be a simple bull or bear flag. It does not model out to trail a stop on a simple bull or bear flag. There's just not enough structure there, and more often than not, it's going to stop you out by having a little bit of a give back, So if you're doing a simple bull or bear flag, and I'm talking about over 1,000 numbers, of course there's exceptions to every single one, it'll model out best just to exit and take your profit. If you have, say, for example, a terminal wedge type of formation, which we actually had at a lot of stocks in this last high, in the S&Ps, as well as some indices. That is a structure which demands a trailing stop, okay? Because it can lead to a bigger win. So even if it doesn't work, you can see if you were trailing a stop on that breakdown from that market top, that is going to be the way that you capture the most amount of gains. And who knows, I mean, some stocks you're probably still in if you're actually trading stocks. So, and then if you are a day trader, let's say, for example, that you are a day trader in the E-minis. If we look at this individual market, it is the market that has the biggest length of line. And now, what is length of line? Length of line is if you took the zigzags during the day, the little wiggles and jiggles, the 5 minute gives you a buy, it rallies up for an hour, then you get a sell, it bounces down for a little bit. If we grab the ends, the opening and the close, and we pulled on it like a cord, like a clothesline, and straightened out all the zigzags, okay, this market has the biggest length of line. Not many other markets offer the same type of trading opportunity on an intraday basis that the S&Ps do. So if you have that type of market and you're on a shorter duration time frame, then absolutely that could be a case where it pays to scale out of your entries, because exits are never as well defined as entries, with any model or strategy. And again, this is over 1,000 trades. You can't look at just say, oh, well, I saw one last week type of thing. So in that case, I know for those that do trade S&Ps, unless you're very good at discriminating those days that are trend days where you just need to stay with that trade all day long and even scalp in the direction of your position, okay? So what I'll do is if I am so fortunate to have caught a good trend day, which you might get one trend day a month per market, on balance, the whole goal is to stay with your trade throughout the day. And this is where something like a volatility breakout system confirms that there's range expansion. You then can also find one or two spots during the day to scalp in the direction of your position as well. I am not a proponent of having a core position on, selling out part and then buying it back, and so therefore trading against your position. And once again, the reason is that a good part of the time you never really get that position back on again. So you'll be better off to have your core position and then have a scalping unit as well that you can trade in the direction of that. So for an example, gold and silver had a huge move, was it like last week, I think, Tuesday or Wednesday or something, to the upside, or maybe Monday, I don't know, everything's blur for me right now. But if you were long that, you want to think about staying long it till the close. And if you do get a little intraday pullback, you want to initiate another long and then scalp out of that for the small profits, and therefore lowering your basis. So that's very different than adding, at higher levels, which is not a good practice either. So that's my 2 cents worth.
So if I were to summarize this, it sounds like your basic essence is commit to the entry, commit to the exit, and trust the statistics. Trust your setup to.
That's very well put. Yeah, that's very well put. Everything is. You have to look at it in the context of the numbers, of the law of multiple numbers, or the law of large numbers. That's what it is. The law of large numbers. You have to look at all that goes on in the marketplace as the law of large numbers, that it's only meaningful when you have a high sample size. And in the markets, they always talk about with statistics, confidence factors and this and that as being around this 34 to 36 is a reasonable sample size from which to draw conclusions. And actually in the markets, it ends up being more like 200 or 300. Okay, so you have to have a sample size of 200 or 300 before your confidence factor increases, to the point that, yes, this has an edge, or this doesn't have an edge, or, this is robust and durable and will hold up into the future.
Got it. Okay. All right. A couple of pro-con contrapositions. Tape reading versus indicators. Fundamentals versus technicals. And distinguishing noise from signal? Just sort of feel free to expound on any of all of that.
Okay, so tape reading versus indicators. They're all one and the same thing. I mean, you're basically tape reading an indicator as well because you have to put an indicator into context. And an indicator is always going to be 1 bar late than the actual price. Okay, so if I'm tape reading, I'm watching price and an indicator. An indicator is just something to help smooth the data and add a little bit of structure if to the price. So to me, you can always have a hard entry such as a buy stop. I'll give you a very common one. A lot of people like to use 5-minute candle bars. And for entry, let's say you've been in a downswing and you start to get a little bit of a bottoming formation, and they'll put a buy stop above the high of the candle bar. Okay, so are you treating that bar as an indicator? You might as well. It could be the same thing, because when you take that high out of that bar, you're going to have the first derivative of the price turn up, because the first derivative, which would be a stochastic or an RSI or any directional based indicator, is basically going to be 1 to 2 bars behind the price. Right. So I think that what you lose with the indicators is the importance of the levels. And that is increasingly important in these markets, that people understand, okay, this level was the high volume area where the most trading took place of the last 5 days. This level was a support level as defined by 2 previous lows. This level is the gap area where everybody sees the same darn thing in the market. So these levels where everybody in the market sees the same thing, and I'm not talking about Fibonacci levels or trader levels or Gann levels.
Right, you mean like hard price levels? You mean hard price levels? Yeah.
Yeah. That these are really important, and just general areas where buyers or sellers came in the past. It could be what was the Globex high and low. When I come in the morning, and I know that you guys are on different time zones and you do different markets, even like Forex markets, but I still have a grid where I can look at the US pit session only for something like the euro currency or the yen, and I can see, okay, all of the US time frame players saw this amount of data during our day session the day before, and then I can see where do we open relative to where did we close, based our US session. And usually, of course, you're going to have a big gap. And then you can have 2 reference points by which you're monitoring how the market moves. Okay, we gap width. Are we going to start trading back into the gap, even though the data itself is continuous, right?
Right. We got to stop here, because this is such an interesting point, and I really want everybody to absorb what Linda is saying. This is such an interesting insight into the understanding that the psychology of the market versus the physical reality of the market, especially for us in FX. We are preconditioned to think that everything is continuous, right? But what Linda is saying, and the way she studies this, is that yes, it's continuous in an absolute physical sense. That means the prices are always trading, but the reality of a guy who comes on the desk in New York at 7 o'clock in the morning, seeing the euro down 50 points from the New York close, or euro up 100 points from the New York close, or the customer, not even the dealer, but the customer who sees that when he gets on his desk at 7 o'clock, is going to create some very interesting demand supply dynamics that could be tradable. Because his reality, he's not thinking about a continuous market. He's thinking, oh, I put on a position here and it's 100 points against me, or 50 points for me. What am I going to do now? Is that what you're kind of referring to?
Yeah, but you have to think about, like, who are the major players in the Forex? It's not the retailer, the individual trader, or anything like that. It's more on the short duration. I'm not talking about trend followers either. It's the banks, okay?
Right.
So you have a whole set of, you have different banks as each time zone opens. And so when we did our modeling of markets like the euro currency or the yen or the AUSI or whatever you're looking at, what we found is that if you modeled out the distribution during the day for when highs and lows are made for that particular day, and this actually goes true for just about any market, you will find that you don't really come up with any edge or anything that's notable as to like, okay, you know, we can say with the S&Ps or the highs are made at like, you know, 8:30 in the morning when New York opens or something like that. You know, and we modeled it out like in 5-minute segments and 15-minute segments throughout the day. So, but what we did find is that if you break it into the sessions, here's Asia open, here's Europe open, here's US open. And for our US opening, we use 7 a.m. Central Time, which is actually is 8 a.m. Eastern Time, because that's when everybody in New York is sitting down at their desks, you know, right. And the big players there with the banks and so forth, and Goldman Sachs or whatever. So if we model it out, dividing the day actually into, we actually did 4 sessions because we actually called also when Europe closed, you know, then the US afternoon session because you don't have any players left. You will find that a lot of times Europe open or Asia open, the highs or lows for that session are made around the opening price. So you could then take a strategy like an you know, an initial balance breakout, which is a popular concept, you know, a market profile concept type of thing. But initial balance, you know, you can look at, okay, do we break out of the first 15-minute range? Do, you know, how do we trade off the opening price? Is there urgency off the opening price? These things tell us a lot about how that market's going to continue to trade for that session. So you can model out the Forex markets that way and come out with some really interesting things. So wow. You see now the difference between indicator-based stuff, which completely loses the context, you know. Sure. And of course it has value. If I have a bias, you know, an upside bias in a particular market, you can bet darn well I'll be buying every 5 and 15-minute bull flag or a 15-minute buy divergence or whatever, you know, it is. It's like little signposts along the way. Absolutely. They serve as wonderful entry triggers, but it's hard to make a strategy alone that will yield profits on a consistent basis that is strictly based off of an indicator.
Right. No, absolutely. I totally agree. I'm just, my mind is blown because I just think what you just said is so interesting and so fascinating. I've seen this intuitively hundreds and hundreds and thousands of times over. I've seen also sort of like these massive reversals where you'll take pound. London makes a spike low in the pound at 8 o'clock in the morning London, and then New York just takes it right back up all the way to, you know, to the other way. You know, this kind of movement just seems to be continuous. And what I meant by customers, by the way, was yes, bank and their institutional customers, which are, you know, some hedge funds and corporates and everybody else who are directly impacted on a day-to-day basis with this stuff. So it's just really, really interesting. So, you know, we're running out of time, but a couple of questions I just wanted to ask you. Favorite instrument, favorite market to trade, and maybe the answer to that is like there is none because you are dispassionate enough to kind of not have a emotional attachment to anything, but maybe there is. Do you have a favorite instrument and a favorite market to trade, or something that you really are super comfortable trading?
Yeah, just to go back because I made notes here. Technical versus fundamental. I look zero at fundamentals. Zero. Yeah, they do me zero. I'm 100% technical.
Right. So. And I heard that, and I'm just actually curious why, because you know, I appreciate technicals, but all technicals are driven by fundamental change.
No, that's not true. Technicals are driven by the short-term crowd movement, people overpaying, it goes beyond where it should, herd mentality. Okay. Technicals are not fundamentals at all. The fundamentals are very long-term drivers, very long-term. They could be monetary stuff. In terms of like data and reports that come out, because we have those every day and, you know, all over the place. If you for one moment believe that like that information isn't known ahead of time. You know, it's more the reaction, the market's reaction to the news, but everything's priced into the market well before you or I will ever see the data, you know. So I just the strongest fundamentals out there are going to be monetary data, and that is a very slow thing, you know. Even, you know, okay, is the Fed going to drop the discount rate, you know, blah blah blah. You know, these guys are not stupid. You know, they've got, okay, it's 65% odds, blah blah blah, and they're hedged every which way up and down, and you know, you just get a lot of knee-jerk reaction in trading, and then of course they'll blame the market's swing on it, you know, and then you look like a week later and it's completely different and they're focusing on some other data point. So yeah, fundamentals are very long-term drivers. They do not do traders any good.
Okay. We will agree to disagree on this one, but I will agree on one thing that I've heard you say before, and this is something that I personally do all the time, which is when news is good, but price action is bad, or when news is bad, but price action is good, is like one of the greatest setups there is, meaning that.
Yeah, but that's nothing to do with fundamentals. That's just telling you that the market's already long, or they're, you know, I mean, if there's good news and the market sells off on good news, it's just simply telling you that everybody's already long and there's nobody left to buy. That doesn't have anything to do with fundamentals.
Okay, but my point was it's a great signal. Like that's a trade. It's a trade that really works a lot. It works like 80% of the time for me, where, you know, if somebody sort of news comes out, there's this massive positive reaction, and then the price just starts going the other way. You trust the price because price is going to give you a much more accurate signal of what's going on. Like you said, something else is going on that that is far more important than whatever is the headline is. That setup really does work really well.
Yeah, but that's been written about for 100 years. That's been nothing new. I mean, they wrote about that in the 1920s and 40s and 60s. It's like, you know, that's kind of.
Yeah, but you know, it still works. That's the thing. It still works, and a lot of and the problem is that a lot of retail traders. This is where the reason why I'm highlighting this is because retail traders actually do the opposite. So they'll look at the headline, it's positive, they buy it, the price starts to go against them, and they're like, but it's still positive. It should go up. I should be holding this trade, and of course they wind up and they go, I don't understand the markets. I don't understand the markets. That's sort of the very, very. I have like 1,000 questions about that particular dynamic. That's why.
Well, that's why I revert back and I say just stick 100% to the technicals, and then you'll quit all the stupid brain talk in your head, you know, because that's a problem for people getting these little voices in their heads.
No, for sure. So, favorite instrument or favorite market to trade, or is you know any market? It doesn't really matter.
The market that I'm making money in. My least favorite is the one that I'm getting chopped up in. No, you know, everything goes through stuff where you're in sync with something. I would have to say that the S&Ps have always been like my best market because they offer the most opportunity, and you know, you have a lot more information there by which you can read the market, you know, such as market internals and you know, the individual stocks and leadership, and you know, it's just a gloriously three-dimensional complex game, you know, with relative strength and the other indices and so forth. You know, I would have to say, I mean, right now, I'm loving gold and I'm loving silver and these types of markets, you know, but I've gone through periods like where, you know, I've hated them too. So, you know, the energies are fabulous markets. They have their own time of day and rhythm. I started trading unleaded gas this year, and I've never really traded that before. So, you know, that's been a good market. It's not something I would recommend to somebody because the moves can be like very big and it's not as liquid. But, you know, it just. So I would have to say I used to love the bonds. The bonds were absolutely one of my best markets, you know, in the in my hedge fund. Like we used to keep the stats on where you know, our biggest wins would come from for the year. So one year, you know, the bonds were our best performing market, you know, but then when QE started, a lot of our models just simply stopped working. You know, a lot of the things that I traded off of, and you know, they became my most hated market. So. You know,
you know, so we actually just had a conversation about that. Very interesting. The presentation before you was all about how dollar yen has completely stopped working as a correlation currency to the equity market. Really, since the speaker was basically saying since Trump became president, there's been a massive divergence between FX and equities. But this is a very, very interesting point. And there's a question here from a reader. It says, do you change your trading strategies as the markets evolve and change, or do you stick with the same tried and true methods? I asked that in the context of when I remember reading an interview with you where you're talking about, in the 90s, bonds and equities were 95% correlated, and then they completely became uncorrelated. And then I remember reading other commodity traders talking about the fact how orange juice, which was like, I forget the relationship, it was either a buy the summer or sell the summer dynamic, and then Brazil came in as a major producer of orange juice, and seasonality completely flipped around the other way. And now we see sort of these century-old financial market rules completely get destroyed by the current reality of mass.
No. Okay, you're misinterpreting something. Okay, correlations are not a basis for a trade because they change back and forth throughout history. In fact, I've seen, the yen and the yen and bonds had like this perfect correlation for 3 years, and this is well before Trump. And then I had a friend who set up a fund that just did this ARB strategy. He had 3 people working for him, and it was based on this, in the Forex market stuff. And then the correlation completely fell apart. So if you actually go back and you look at 2 to 3 year periods in history, you'll see times, for example, where gold and the dollar were positively correlated for 3 years,
right,
and then times where they were inversely correlated. So correlations are not a basis for a trade. Seasonals are not a basis for a trade. All these external things are not bases for trades, just like fundamentals are not basis for trades. They are what add the color. They may or may not increase your confidence level. My style of trading, nothing has trade. I am there looking for, can I call the directional bias for the day, and are there odds of range expansion for the day? Period. It doesn't matter what the market is. It doesn't matter what environment we're in. Can I find an edge where there could be range expansion, and can I find an edge where I've got a higher degree of confidence that it's going to be a low to high day or a high to low day? Period. If some correlations or market volume or seasonal factors or commitment of traders report, give me a little bit of a stronger feeling about it, that's great, but they're never the basis for a trade.
Interesting. Okay. All right. Sounds very, very good. Okay, guys, I'm going to just throw out, if you guys want to, let me see if there's any questions here that I'm just feel free to type in just the last few questions, because I've already kept Linda here 45 minutes beyond her time. I have a feeling, here's a question, I have a feeling I already know the answer, but I want to repeat this here. So Lachman is asking, I've seen candlestick patterns failing so many times that I've lost faith in them. Some have high quality patterns failing on daily, weekly, monthly, as well as on significant support resistance zones. Do you trade them? What's your view?
Well, I don't know what you mean by saying failing, okay? Because first of all, I don't use candlesticks on intraday data. I do love candlesticks on daily data, but a candle is telling you what's happened. It doesn't necessarily have forecasting value. It can tell you, let's say there's a fat tail, okay, and like we had a fat tail in the bonds, 2-3 days ago when we had that huge swing high, and we sold off deeply, and then we sold off deeply the next day, and then left a tail in the other direction and came back up. So they're telling you about that price action. It's not necessarily forecasting the next day. So they're not going to be, yeah. So
how do you absorb that action? If you assign no forecasting value to a reversal candle or like a pin bar, what value? How do you assess it within your own trading then?
Well, it all comes down to context. That's what I'm talking about with indicators or an individual candle or something like that. Is that it takes time and experience and many years to be able to put something into context. So for example, the huge candle that we had On the bonds, yes, that was a reversal candle. Yes, it left a tail. Yes, it might have been a, whatever, a key reversal day. But we also had just made a very large standard deviation move in that market, something like, I don't know what it was, 5 standard deviations or something. So typically, after a large standard deviation move, and really, I think that the Forex people should concentrate a whole lot more on understanding the concepts provided by market profile, okay, which isn't as linear as indicators and candlesticks, but it gives a lot more instruction on context. And so you just had a very large standard deviation move, and you could call, for example, if you looked at the Aussie dollar, that's called single time framing, probably the strongest trend there is. So when you've had a market that's been single time framing like that, typically what will happen is it comes back into balance. So with the bonds, when we had that big candle reversal, it's going to signal the start of a trading range more likely than not, as opposed to a whole nother swing down in the opposite direction. So because it was preceded by a large standard deviation move, now we're going to look for a rotational trading range. And it just so happens that these spiked tails up and down are very fast, urgency on the part of the market participants, but more of a short duration. Does that make sense?
Yeah, it does. It does.
Okay.
So that actually sort of like brings me to my final question. I thought I heard you say this, but I just want to confirm that you don't believe in 100% systematic approach. Is that correct? Or
Hey, if I did, I would be sitting on a freaking beach drinking coconut drinks. Okay, seriously. After 40 years, and I told you I owned 140 servers. I don't even want to tell you how expensive that was. So we were at the cutting edge of doing this stuff. Yes, there are entities that make insane amounts of dollars, 100% systematic. How do they do that? Let's look at the firms that do that. Renaissance Technology has been doing it for 20 years. They have 20 PhDs, the most insanely sophisticated infrastructure. They are working 20,000 patterns 24/7 in 74 global markets, all on extremely low leverage. Can you compete on that level? Can I compete on that level? No, absolutely not. If I have TradeStation and I love it for doing some modeling, am I ever going to create a system that I would trade that on a mechanical basis? No, but it doesn't mean that modeling doesn't have value. That teaches us things to learn about the markets. And if you want to look at algorithmic or systematic ways that you can smooth your bottom line, consider this. How about you as the trader pick the discretionary entry, and then you do what we call bracketing the market. You put in your initial stop, you put in your little exit strategy and walk away. That's different because you selected that data point. It's not like you had an alert popping up saying buy here, which doesn't necessarily have the ability to put things into context. That's one way. The second way is you're watching the market, you're tape reading, or you're watching your indicator or whatever might be. Some people are not as confident in pulling the trigger. So therefore, put a buy or a sell stop in to pull you into the market, or bracket a trade. So what that would mean is I want to buy the S&Ps down in this 62 area in general. I'm going to work a bid at 61.50 if they drop a little bit more, and if they don't drop, I'm going to put a buy stop at 63. So at least I'm in. If I don't get my bid and it turns, now at least it pulls me in. So that's another type of execution strategy that you could say is systematic algorithmic. And on the flip side of the coin, a lot of people like to pull the trigger themselves, but then let the machine manage the trade, because as you know, all objectivity goes out the window, and either people get overly anxious to take their trade off, or uncertain, or they get shaken out in the noise, and noise is not going away. you know, it's greater than ever, and it's a challenge for sure. The shorter the time frame you're on, the bigger the noise level. So I suggest you don't look at too short of a time frame. You will not make a living, because
What do you, yeah,
I've not seen it done.
speaking of that, so my two final questions here. What do you think is a reasonable time frame for retail traders to look for setups? So like sort of a time frame where they have a reasonable chance of maybe having an edge.
I think if you go down and get away from the concept of looking at like 2-minute charts or 5-minute charts or something like that. I mean, you can look at a 2-minute chart for sure to fine tune your entry, okay? But you should really be looking at the 30, the 60, the 120 minute, you know, or 240 minute to have the wind behind your back. So you can use a very short-term time frame to help monitor and your confidence level, you know, at getting in at a good trade location. But here's the difference. You want to be seeing that trade location on something that it's at least higher than a 30-minute time frame, you know, 6 hourly, 2 hourly, you know, that type of thing.
Okay.
So there's room for both to work together.
Okay. Now, and the final question, you know, I've always say this to people, is that low leverage will wash away a multitude of sins. Like the single biggest mistake most people make is that they just simply over lever and they don't give themselves the time to make mistakes. So I think you're pretty much in agreement with me on that. But what I'm actually curious is if there was a, you know, young Linda Raschke with $10,000 in her retail account, what percent risk, you know, and she was starting out, would you recommend she take on a trade? What kind of lever factors should she use to give herself the minimum amount of chance of not blowing up or of just sort of surviving?
You know, if you're first starting out, you should be doing no more than one contract or the smallest size, the smallest, teeniest size that's a notch above trading a simulator. All right. You want to be until you can show some consistent profitability over a 3-month period. And I don't mean getting lucky and having 3 great trades in a 3-month period. I want to see a steady equity curve of at least 3 months.
Right.
Probably more like 6 months before you even start to discuss leverage and percent risk and all that kind of stuff.
Would that go back to your idea of sample size? So 3 months, you know, if you're day trading, what you're saying is that you really want to do a couple of hundred trades and have a, you know, positive record after a couple of hundred, maybe even 300 or 400 trades before you even have any sense that you're doing something correctly.
I want to see somebody have a hard and fast and true methodology that they've modeled, that they have a high degree of confidence in, and they're still not futzing with. And people, what'll happen is, you know, there'll be an error or a loss or something like that, and then they're immediately tweaking their strategy, okay? Right. You know, or what they're looking at. Right. I want to see somebody arrive at something, then say, I've arrived. I am trading, you know, volatility breakout system, or I am trading, you know, hourly buy divergences, or you know, this is what I do. I want them to reach that point before you start increasing your size. And I want them to prove that, you know, that this is what they're doing, you know, by some consistent performance record, and then prove that they also have the mental temperament and fortitude that they're not going to start doing all these marginal trades on the side.
Right. Interesting. Wow. Okay. You know what? That's the best advice ever. I think I'm going to cut it here. We've gone an hour over. I feel like Howard Stern, you know, like who always goes.
Oh, you're a great moderator. You really are. You know, you pick out good questions, and you immediately, you know, put them into the wraps with, you know, the environment that you're in and the arena that you're in. And you know, my parting thing that I want to say is that, you know, it's all good. You know, this is such an amazing field to study till the day that we die. And what I see with the people that really make it is that just like you, trading is your lifestyle. It's not like a day job. It's not like day trading. It's like the people that you hang out with. You know, if you're with a spouse, you introduce them to it. You know, you have a club, you have your buddies, you have friends online. You're always ordering books. You're always playing with the charts. You're always doing your own research. You know, I mean, you know, it really, it takes a lot of hours, but so does any person that has their own business. You know, if you're an entrepreneur or you're a professional golfer, you're a professional rock and roll star. Look at these guys that, you know, I just saw Mick Jagger. It was so cool. He was like in his mid 70s and he's up there touring in Chicago. And I mean, this dude is like, he's on planes all over the world. He's traveling, he's practicing, he's recording this, that. This is his lifestyle. This is what he does. You know, and so it's sort of the same in the trading universe. You know, if I look at these people that, you know, my husband used to do the execution for Paul Tudor Jones or these very, you know, well-known names and stuff. This is what they do. Tudor Jones has monitors and screens in his bathroom walls. You know, I'm sure he's, graduated a little bit away from that because he's got so many people now that operate more systematic profit centers. But you get the point. You know, these are the people that you hang out with and the functions you go to.
Right. These days, all we need is an iPhone, but we get the same concept. We're definitely there. Belinda, thank you so much. Thank you for staying longer. Enjoy the weekend in Chicago. I hope it's nice and sunny like it is in New York, and you have a great, great time. We're going to obviously record this video. This interview has all been recorded. I'm actually going to go through it. I'm going to do bullet points. There were just so many incredibly valuable kernels of wisdom. I'm going to extract all of that for you guys. Please, everybody, go to Linda's website. I will send out the link and buy her book, Trading Sardines.
It's very thoughtful. Yeah, it'll make people laugh. I promise. It's not a dry, boring trading book.
Definitely not. Definitely not. And thank you one more time for just entertaining us. It's been a pure pleasure. Everybody have a wonderful weekend. I'll see everybody tomorrow at a bright early time of 6 o'clock in the morning, New York, and 8 p.m. Australia. And Linda, thank you once again. Have a great weekend.
Everybody have a good weekend.
Bye-bye.